Welcome to WHU Inside Business. My name is Katrin Baedorf. I'm here at WHU Director at the Center of Asset and Wealth Management. And I'm very happy to welcome Dr. Andreas Bohn, Associate Director for Risk Management at Boston Consulting Group. Today we want to talk about risk management in the changing banking sector. The banking sector is currently facing many challenges after the global financial crisis. Risk management in banking has been transforming in response over the past decade and continues to experience even more changes due to increasing regulations and a changing business environment in the future. What were the main developments in risk management in the last years, and how did its importance change for financial institutions?
Since the financial crisis, significant efforts have been made in order to improve the risk management for banks across all asset classes. In the Basel II.5 changes, the incremental risk charge was introduced in order to cover default risk for securities. Then the stress bar concept was introduced in order to cover exceptional market movements, and the third one was securitizations were treated much more rigorously than before. Then with Basel III, additional topics have been introduced. Number one, the leverage ratio in order to curb the overall exposure of banks. Then the CVA was introduced in order to address the counterparty risk which materialized after the default of Lehman. And finally, liquidity ratios were being introduced, the LCR and the NSFR, which cover basically the situation of stressed environments in the funding market, as well as the overall funding structure of banks in order to ensure that enough long-term funding is available. Now, in the recent years, the Fundamental Review of the Trading Book was being introduced, which basically summarizes and straightens out the respective market regulations, and the interest rate risk in the banking book regulation has been introduced, which is going to be live in 2018, which also covers the structural risks in the banking book, in the classical banking book. Finally, we are now talking about capital floors for standardized approaches, which then are aiming to standardize the capital requirements across banks and countries. Furthermore, in addition, stress tests as additional risk tools have been introduced. It started in the US with the CCAR, so the regulators and the banks themselves, they didn't trust the metrics, the risk metrics themselves anymore, but they also wanted to see what kind of impact certain stresses in the market would have. And therefore, the discipline of stress tests is being developed both in the US, but also here in Europe with the EBA stress test. And this will be an important risk management tool going forward.
In the future, the banking sector will continue to evolve and therefore also has to develop new strategies for risk management. What do you think will be the basic trends in risk management in the future?
Certainly better usage of data, faster usage of data, and more analytical usage of data. So what I mean with that, banks are now forced to calculate tons of risk metrics and other data on a daily or monthly basis. There will be a trend towards more actively not only reporting those numbers, but also actively using those and interpreting those numbers. People will try to aggregate all the risk information to one place and store them holistically and centrally. And some banks are thinking about introducing big data technologies in order to allow the analysis of the data in an efficient and appropriate way, and to get insights both from a, let's say, business strategy, but also from a risk strategy point of view. Yeah? So that they are trying to more actively define risk strategies on the basis of the data which they possess. This is one trend. The second trend will be more frequent calculation of risks. Yeah? So obviously we have high frequency trading and automatic trading in milliseconds, but risk systems in the moment are hardly able to record these data, which is being produced on a high frequency basis, and currently no risk figure or risk metrics, which has to be reported to regulators, encounters such intraday risk positions. And my presumption would be that there will be a trend towards capturing the intraday positions and intraday risks which are coming from trading activities.
Dr. Bohn, thank you very much for sharing these interesting insights with us.
It was a pleasure. Thank you very much.